back, everybody, to WWTA News. Thank you for returning for another episode. More news. Obviously, more news to get through. We're not going to waste any time. You know why you're here. So let's just jump into some of these articles and see what's going on. First article, IRS in 2022 tax guidelines to treat non-fungible tokens as stable coins and cryptocurrencies. Interesting. The U.S. Internal Revenue Service has given non-fungible token investors new clarity about how the assets are set to be taxed. As per the IRS 2022 tax year guide, all digital assets, including stablecoins, non-fungible tokens, and cryptocurrencies, are set to be taxed under the same rules. The IRS also seems to have carefully worded the document allowing for the taxing of any new digital asset class in the future. The agency said if a particular asset has the characteristics of a digital asset, it will be treated as a digital asset for federal income tax purposes. So, and with that, I would say, yes, I know it's the worst thing ever. It's like, why won't they stop? They want to tax. It's not just the United States that's doing this, and it's going to do this. There is going to be a lot of financial growth as the money goes from one hand to the next. It's going from one system to another. So a lot of people are going to be getting or growing value in this space. And obviously all countries are going to want to tax the people that are involved in this stuff. I mean, it is what it is. There's no ducking and dodging. This is something that just about every country is going to do. I wouldn't doubt if all countries did it for the benefit of gaining the taxes there. So it makes sense. You're taking something, it becomes something. You know, they want to tax you on what you gained. You know what I'm saying? Is it fair? I'm not here to deliberate that, but is it factual? That's what they're doing. Yes, it is. It is what it is. You know, let's continue. Taxpayers who have disposed of any digital assets in 2022 through a sale, exchange, gift, or transfer will now have to report and pay capital gains tax on the action. Yes, so these are taxable events. When you sell a digital asset, cryptocurrency, or a digital currency, whatever you want to call it, once you sell it, the price you bought it at, there's a possibility for a gain in value or a loss in value. So that's what they're talking about. The exchanging, swapping out, same difference. You possibly gained and you possibly lost. Finances on that. As a gift, if you gifted somebody, I mean, I would only imagine there's got to be a certain number. You know what I'm saying? Like, but even how would you do that? But like, if you gift, because this is crazy, and I'll say this as an example. If you gift somebody $20 worth of a currency, and then by the time they try to exchange it out, well, because then it would fall under the tax of an exchange, because they got to exchange it. So now if you gifted somebody something and they cashed it out then, or they cashed it out later, well, if you sell it, that's a taxable event. So I don't even think gifts should be in there because it's kind of self-explanatory. The only taxable events you're going to see are basically selling or exchanging. I don't even see how they can say transferring, because if you transfer cryptocurrency from one of your wallets to another wallet, how in the world is that a taxable event? That doesn't make any sense. That's dumb. So all right, this is a lot. Let me go ahead and try to see if I can make sense of this, because this is totally dumb. If this is the way they're looking at legislation with cryptocurrencies, this is totally stupid. All right, so let's just think about this. Somebody gifts you $20 worth of a cryptocurrency, the value goes up on it, and then you go to spend it in a store. If you go to spend it in the store, then the taxable event is still right there at the store, right? So between you and the store is a taxable event. You just exchange that currency for an object or a service, right? So at that exchange, they can say, okay, well, he turned over, even though it was $20 when he first got it, it's now $50,000 worth of value. Let's say he exchanged $25 worth of that currency. Then that $25 that was exchanged becomes a taxable event for me. So like transfer doesn't make sense. Gift doesn't make sense, because if you received that $10 or $20 worth of currency a year ago, you received it into that wallet. They've got that transaction received in that wallet at $20. Now, if 2 years ago that's what it was, but here you are today, it's $10,000 worth of value or currency, and you go to make a purchase with it, it still knows it's in your wallet and it showed up in your wallet 2 years ago at a value of $20. So the taxable event right there is the purchase at the store or wherever else it is for that amount of currency right there. So that there's the taxable event, and you can then see that through when you go to file taxes at the end of the year, because essentially that which you were gifted or that which was moved into your wallet has grown in value. Is it fair? I don't think it's fair per se that somebody gifted you something, it grew in value, and then you turned it in or used it or used it to buy something, and now you're held liable. But you were, because let's just think about this a little clear. If I give my mother $20 worth of something, and then for some reason that $20 becomes the value of $10,000, why should she be held accountable for me gifting her something that had a $20 value? That's like if I gift my mother a baseball card, and then 2 years down the road, let's say that baseball card was $20. 2 years down the road, that baseball card has a value of $10,000. She goes to exchange that baseball card for cash, and they say, we'll give you $8,000 for it. And she says, I'll take it. Is that a taxable event that she received something that was gifted to her and now she sold it? You see what I'm saying? So just because you can track it now, you want to make it a taxable event where you can then gain value off that. To me, that's even weirder, because that was a gift to somebody. Who knows what the value is going to be? That's just irrelevant. The fact of the matter is, it was still a gift. Now, I understand from the same breath, devil's advocate, that when somebody receives an asset great like a property, right? So your grandparents going to pass away and they left in a will, they left you a home, and the home's valued at, I don't know, $150K. You just received an asset at $150,000, and I'm playing devil's advocate here. I'm trying to see both sides of the coin. So you received this asset, which is a home, at $150,000, and it's worth now, I don't know, $180,000 to $200,000, and you decide you want to sell it. Well, the taxable event is going to be at the sale. Okay, so when you received it, it was valued at $175,000. You received it into your custody. Now, when you go to sell it, now because it's gone up in value since the day you received it, it's gone up in value. Now they want to tax you on that for a gain. So that makes sense. That makes sense. But you taxing me at the point, just because I sent to this other wallet, so you're going to make that a taxable event? That doesn't make sense. It should only make sense at the point of sale or exchange. And I hope that maybe that's what they mean, and I'm just not understanding from what I'm reading, but I'm hoping that they're following the same way they do other things, such as homes, real estate, the same way, because then that makes sense. But the way I think I'm reading it, I could be wrong, and maybe I am just wrong, but that just looks retarded to me. But let's continue, because I went on a tangent and I shouldn't have did that. I should have literally just kept reading the article, but we're going to get to it anyway. Bear with me. That's why you're here. In addition, anyone who receives NFTs as compensation for services or disposed of any digital asset that they held for sale will come to have to declare this as income. Right, so disposed, I don't know what you mean by disposed. Thrown it away, you no longer have it, because that's what I understand disposal of, throwing something away. But if you sold it or you exchanged it, then of course we're still talking about a taxable event. You know what I'm saying? It goes on to say, it's worth noting the IRS also made the decision not to classify non-fungible tokens as collectibles, alongside assets like collectible art, antiques, or gems, which are taxed at a different rate than stocks or bonds. Collectibles are taxed at a rate of 28% compared to assets such as stocks, bonds, or cryptocurrencies, which are taxed at 0 to 15% or 20% depending on the seller's income. Now that's even crazier. You're going to increase the tax based on my income? I mean, you know what I'm saying? Like that in itself is like, it's crazy. I tell you, it's crazy. Yeah, so Portugal, which was once seen as a safe haven for crypto investors, introduced a 28% capital gains tax on cryptocurrency gains made within 1 year in October 2022. So look, yes, I devil's advocate, I understand they want to get taxes out of it because we're going from an old to a new and money's transferring from one group of hands to another group of hands. I get it. I understand. But I think they're doing the best that they can to try to represent all parties and still be in a position where they are to receive taxes, because technically when you look at a lot of these things, they are assets, commodities. Some of them are securities and some of them are currency. So I get it. I'm not mad, just playing devil's advocate, but I'm just saying it's something to think about. Let's keep it moving. All right, next article says FDIC head calls to limit stablecoins to permissioned blockchains. Quote, payment stablecoins would be safer if they were transacted on permissioned ledger system with a robust governance and compliance mechanisms, said the FDIC acting chair Martin Gruenberg. In remarks prepared for a speech at the Brookings Institution, Washington-based think tank this morning. The ability to know all the parties, including nodes and validators, that are engaging in payment stablecoin activities is critical to ensuring compliance with anti-money laundering and counterfeiting the financing of terrorism regulations and deterring sanctions evasions. He continued, adding that innovation can be a double-edged sword. So, yes, the stable coins do make things safe, but it's no different than saying that money is used for money laundering, the dollar. So what are you really saying? You people can track all this stuff. The most important thing is because they can track it. You know what I'm saying? It goes on to say the acting head of the Federal Deposit Insurance Corporation, a U.S. bank regulator, is calling for more restrictions on stablecoin issuance. Most notably, the bank regulator is suggesting limiting stablecoins to permissioned blockchains. You might consider the addition of permissioned users as an extra blockchain security system. Administrators maintain an access control layer to allow certain actions to be performed only by certain identifiable participants. Records are kept within the blockchain of who is involved in the transactions. This makes permissioned blockchains different from public blockchains. And just so we get a brief understanding of permissioned blockchains, it says, what is a permissioned blockchain? A permissioned blockchain is a distributed ledger that is not publicly accessible. Nope, the public can't just see these transactions. It can only be accessed by users with permission, hence permissioned blockchain. The users can only perform specific actions granted to them by the ledger administrators and are required to identify themselves through certificates or other digital means. So when you think about central bank digital currency, this kind of makes sense for that, for central bank digital currency, right? So because then they can control every freaking thing they want to control about them creating that currency. That'll put us in the same boat we're in now with the dollar as it is. You know what I'm saying? It's like, what are they saying? It goes on to say the acting FDIC chair also cautioned about statements misleading users about the availability of federal deposit insurance for any given crypto asset product, violating the law, an issue that the FDIC has brought up with some of the biggest names in the industry. We will continue to work with our supervised banks to ensure that any crypto assets related activities that they engage in are permissible banking activities that can be conducted in a safe and sound manner and in compliance with existing laws and regulations, added Gruenberg. So, I mean, it makes sense. It does, truly. It's really nothing to argue with. The only thing I'll say is basically when you're talking about controlling and you don't want people to see it, you're talking about private cryptocurrencies. They have those blockchains. But to me, it just seems like if you're going to make a central bank digital currency, then of course you want to have a permissioned blockchain where only the people with permission to access and do changes to it can do that. So it benefits you and your country and your currency of your country. So yeah, I get it. Not the end of the world. All right, next article. 2 U.S. men sentenced for stealing crypto using SIM swapping techniques. I bet. I've heard of this one before. Have any of you? Eric Meggs, 24, has been sentenced to 2 years and 1 day in prison. And Declan Harrington, 22, has been sentenced to 2 years and 7 days in prison. The FBI had arrested Meggs and Harrington in 2019. Meggs pleaded guilty to each of the 7 counts, charging him with conspiracy, wire fraud, computer fraud, and abuse, as well as aggravated identity theft in 2021. The initial allegation was that the duo tried to steal more than $550,000 in cryptocurrency. The latest announcement says the duo targeted at least 10 identified victims, stealing approximately $330,000 worth in cryptocurrency. 2 men from Massachusetts have been sentenced to serve time in prison for an extensive scheme to take over victims' social media accounts and steal their cryptocurrency using techniques such as SIM swapping, according to a press release by the Justice Department. And yes, you got to keep your stuff close and safe because, I don't even understand why so many people are heavy with social media. It is what it is. I'm not here to judge. I'm just saying. Hackers are out here. They want to steal. Nefarious actors exist. It is what it is. You gotta prepare yourself and protect yourself so that you don't have all your funds stolen and then you're in a bad predicament. You know what I'm saying? It goes on to say SIM swapping is a way of bypassing two-factor authentication using mobile operators to break into sensitive websites like crypto exchanges and online banking. And another secret, you shouldn't leave your crypto sitting on an exchange, obviously. It goes on to say several individuals in the cryptocurrency space have fallen victims to SIM swapping. Right, so, the way you can get into the those accounts obviously is because you get to ping the website. They'll give you a code so you can get access to your exchange. You know what I'm saying? So it's the same thing like your online banking accounts. They'll ping it, get the code, and they'll go into those accounts. But you shouldn't have anything sitting on exchanges because of potential risks such as these. Meggs and Harrington targeted executives of cryptocurrency companies and others who likely had significant amounts of cryptocurrency and those who had high value of OG, which is slang for original gangster, social media account names, the announcement said. All right, guard yourself. Don't be stupid. And don't leave your money on exchange. Put it in a wallet. Keep moving. Next article. Ripple lead engineer steps down after a decade at the company. Bougales stated that all good things must end, even if this decade-long stay at Ripple has been fantastic. The cryptographer and software engineer who worked at Samsung before joining Ripple added that his departure in the coming weeks would not affect the XRP ledger. And what of the XRPL? Its long-term health and success isn't predicted on any one person. Isn't predicated on any one person. I'm confident that it will be just fine, thanks to talented and passionate individuals who contribute and participate each in their own way. So, yeah, he's totally cool with it, right? Wish they tell us where he's going. He continued that he would not join a rival blockchain project or get involved in DeFi and NFTs. According to him, his plans would be revealed later. Bougales' long time at Ripple means he is one of those who played an integral part in the development of the XRP ledger. He recently oversaw the XLS 20 amendment introducing non-fungible tokens to XRPL. The proposal could come to life as early as October 31st, as the network validators are currently voting on it. So, yeah, where is he going? It's going to be released here soon. We do understand that XRP, the ledger, is going to be heavily used, especially when we talk about banks. So I don't think anybody's just going to really disappear from that because it's a lot going on with that. Hey, look at that. We're at the end. There's the end. We got to the end. You guys made it to the end of the video. High five. Great job. I hope you liked the video. Hit that like button. Don't forget to share this video with family, friends, loved ones, or anybody you think could use any of this information to better themselves for tomorrow. Other than that, I'll catch you all in the next video.